The Eurodollar futures curve has inverted, and that's bad news for the global economy, for you, for me, for everyone. We're going to talk about it on a special two-part episode of Eurodollar University. My name is Emil Kalinowski. I'm joined by Jeff Snider, the head of global research for Alhambra Partners. And ladies and gentlemen, this has happened before. In December 2006, the Eurodollar futures curve inverted, and just 8 months later, we had the global financial crisis begin. It happened again in June 2018. And by November, we had the global economy downshift abruptly into a much slower rate of growth. And by January, the best laid monetary plans of mice and central bankers were thrown aside. July 2020, similar thing. There was a cramp, there was a kink in the curve. And maybe it's a coincidence, ladies and gentlemen, but by the first quarter of 2021, many money markets around the world said that the recovery, the reflation, the best days of that were behind us, and it's happened again. Jeff, whenever we bring up the Eurodollar futures curve, people, they're not interested at all. And I remember once bringing it up to some guy, and he said, wow, we're just blowing right through nap time, aren't we?
Yeah, it's funny. I have the same experience that you do. When you bring up Eurodollar futures, people start checking their watch and they fidget in their chair and they look around. And even in our modern electronic world, you can see, I'll write an article and you can tell they'll read the first paragraph and click. Go to YouTube. As soon as we mention Eurodollar futures, the video just turns right off. You know, I guess I understand why that is and what it's really about. It's just, to me, you got to understand that this stuff is extremely important because the Eurodollar futures market as a whole is an extension of the bond market. And it's a very important extension of the bond market. I think we'll talk about that a little bit here, why that is. So to just, to kind of set it aside and say, I'm not going to take much interest in Eurodollar futures, I think you're doing yourself a very big disservice because there's an enormous amount of information embedded in the curve, and not just an enormous amount of information, but good information, useful information that has been validated, as you just said, validated time and time again. When we see these things happen in the curve, you can almost set your watch by what's going to follow from it. It's been that good of an early warning indicator to tell us very important things about what must be going on in real time inside the monetary system and the global economy. So Eurodollar futures, it gets complicated. It's a bit of a mess. It's not necessarily intuitive, but it's worth your time and effort.
You try to make sure that we're aware of that fact, that this is important. You start out with the title. This is a big one. No, it's not clickbait. Posted on December 1st, 2021. And then in bold, italicized letters, you write, these derivative contracts have been the most reliable, especially early warning indications that exist. Maybe one of the reasons that people are yawning about it is that it has to do with LIBOR, and LIBOR's on the way out, Jeff. And so let's talk a little bit about first principles. What are Eurodollar futures? What do they represent? Why do we tie in LIBOR? What's that about?
Well, that's what they're priced on. It's based on, you get paid, obviously they're futures contracts that pay out on an index tied to 3-month LIBOR. So they're inextricably linked to 3-month LIBOR, which is a good thing because 3-month LIBOR actually does tell us something. Yes, you're right. The rumors are that LIBOR's days are numbered. I'm not so sanguine about the ability of policymakers to just ditch LIBOR. I think LIBOR might be around a lot longer than people might expect, especially if you're only listening to Federal Reserve members or something like that on the topic of LIBOR, because LIBOR has credit information, it has liquidity information, it has a lot of deep, very, very good information about what's going on in the state of the monetary system in particular, and what are the implications of that, which is why we look at forward LIBOR, futures contracts for LIBOR, not just where 3-month LIBOR is today, but where does the market think 3-month LIBOR is going to be a couple years from now, for example. That's an important, very important part of fixed income, bond markets, how credit and money flows through the economy. So again, Eurodollar futures tied to LIBOR is a good thing. It's a positive thing. It's an aspect, it's a very fundamental aspect of what we're trying to interpret and evaluate.
LIBOR, London Interbank Offered Rate, ladies and gentlemen, in case you didn't know. And of course, London is the home, the birthplace probably, we don't know, of the Eurodollar offshore, off-balance sheet, off the regulatory radar monetary system that governs our global economy. So it's important to know what this rate is signifying. As Jeff just said, it's not just the next 3 months, it's predictions well into the future, many years into the future, about where that 3-month rate will be. And it's a little bit like the Treasury yield curve, right, Jeff? There are different parts of the LIBOR curve. Tell us a little bit about the front years and what they respond to, and then the middle, and then the further out years.
Yeah, we got to remember that these things are tied to, again, fixed income processes, bond market, credit markets, debt, and things like that. So you have large pocketed, large financial institutions that are doing all of this money business, all this credit business, and they use Eurodollar futures primarily to hedge their positions, to hedge against their perceptions about what's going on. So they establish positions on 3-month LIBOR based on what they think is going to be moving 3-month LIBOR at whatever time they need to hedge, whatever set spreads or whatever they're using in their models to manage risk in their big, huge, massive balance sheet positions. And what that means is you have to look at what is it that influences LIBOR in, say, the short run versus the intermediate term or the longer run. And so the way Eurodollar futures work is that the CME has allowed you to buy what are called packs and bundles, which usually means a pack usually means the four closest quarterly contracts. For example, the white pack today would be the December 2021 contract, the March 22, the June 22, and the September 22. So those four would constitute what's called the white pack. And then after that, the next four, which would begin with the December 2022, and then the ones thereafter, is called the reds. The whites and the reds, which amount to the 8 next quarterly contracts, which is about 2 years of contract maturity, those are the ones that respond to 3-month LIBOR, mostly being influenced by Federal Reserve monetary policy, because LIBOR and the Federal Reserve, they do share a relatively close correlation, much tighter correlation before August 9, 2007 than after, but still, because the Fed influences money markets by what it pays on IOER and RRP and things like that, 3-month LIBOR does bear some resemblance to what the monetary policy is in the short run. So the whites and the reds are going to be heavily influenced by not just what the Fed is doing now, but what the Fed says it's going to be doing in the near future. So if the Fed says we're going to taper, we're going to hike rates, go back to 2018, for example, they were hiking rates, then the whites and the reds are going to reflect what the Fed thinks it's going to be able to do in the short run. So you'll see this. If they're hiking rates, you'll see the whites and reds reflect that, and rising prices or falling prices, rising nominal yields, which means steeper curve.
Sounds just like US Treasury bills, also a money alternative. They're all related and all reacting to what the Federal Reserve may be doing most of the time, right? But during shocks, these markets might go off on their own. But okay, so that's the early part of the curve. Let's talk about the notes and bonds equivalent of the US Treasury yield curve in Eurodollar futures. Do they also reflect kind of the long run economic expectations, or what is it that the longer term maturities further out, what are they signifying?
Yeah, once you get past the whites and the reds, you get greens, blues, golds, purples, and some other colors I don't even remember. But really, the greens and the blues, sometimes the gold, what they're telling us is less about what the Fed thinks it's going to do. And because you're further and further away from today, you get into that gray area where, okay, the future is really that much more uncertain. So maybe the Fed thinks it's going to be hiking rates, but over time, it probably, it might be the case that, well, the Fed may not be able to hike rates. And so if as much as financial participants are hedging based on monetary policy in the whites and the reds, when you get to the greens and blues, it's more about, okay, what's the economic conditions really going to be like? Yeah, Jay Powell can, the Fed can continue hiking rates or cutting rates, as the case may be, for quite a long period of time, because, if we see problems today, it may take a while for those actually materialize to alter monetary policy course. So the greens and blues are really looking out at the possibilities beyond the short run of what the Federal Reserve actually might be able to do. Not what it plans to do. What it plans to do, that's whites and reds, but what it might actually be able to do. And what it's able to do is maybe not the same thing as what the Fed thinks it will be able to do. And that's what really happened in 2018. We had the case where the whites and reds, steeper curve, rate hikes, the Fed was, incredibly hawkish. But then you started to get into the greens and blues where the market started to really hedge against what were then rising deflationary problems that were, really starting to bug the market to that much of an extent.
One last first principles item before we move on to 2018. Inversion, what is it? We're assuming, right, that these money curves are supposed to be upward sloping. Tell us why, and tell us if inversion is indeed that thing that Leonardo DiCaprio does with an idea in your mind, or if it's something else.
Yeah, I don't know if we have enough talismans to do that kind of a discussion, but in some ways that's the case, right? I mean, inversion is essentially it's unnatural. It's an upset to what is the natural order. And as you just said, curves are supposed to be upward sloping. Upward sloping is beautiful. It's positive. It's optimistic because it says that we believe interest rates are going to be rising through the future because we think things are generally good and healthy and moving in the right direction. We would want interest rates to be rising, not falling, because we realize that rising interest rates, especially where we are now with unnaturally low interest rates that have been held low for a very long time because of constant deflationary pressures, not the Fed, but constantly, interest rate fallacy, deflationary pressures. We want a steep Eurodollar futures curve because that would mean the market is saying not just reds and whites in monetary policy, but also greens and blues, reflecting how we expect interest rates to continue to rise beyond the foreseeable horizon, which would suggest normalcy, the world getting back to economic climate that is actually more like what we used to associate with legitimate economic growth and the legitimate economic booms. So we want to see an upward slope to the curve because upward slope is beautiful. Upward slope is health. Upward slope from today would mean, hey, we're getting back into a situation where it's realistically a recovery, getting back to normal, getting back to actual economic booms and things like that.
And especially, as you know, in this post-2008 world, they should be particularly steep because we're so low on the y-axis. So we should absolutely see naturally inclining steep curves if there's any sort of hope of recovery and reflation. Let's talk about
steep reds and whites, steep greens and blues, and even steeper golds and purples. Let's get all the colors of the rainbow, all the colors of the Eurodollar rainbow moving up at this, at a 45-degree angle or better, because as you just said, Emil, we're at such a low state here, such a pitiful state, that's really what would tell us that we're on the road to actual legitimate recovery in economic health, monetary system, or what is the term Janet Yellen used a couple of years ago, financial resilience or resilient system. That's how we would know. The Eurodollar futures curve would tell us that, and it would tell us that by being very steep. And to get back to what you just said, inversion is the opposite, upends that natural order where we see not only does the curve flatten out, especially in the greens and blues and beyond, what it does is that eventually you get an inversion like the yield curve where the next Eurodollar futures contract price in line is actually higher than the one before it when it should be lower. And so that's sort of an expectation where the market is saying, okay, the current expectation for 3-month LIBOR is this. We're starting to get the sense that at some point, something's going to happen, or a cumulative some things are going to happen, that rates, maybe there's a risk they start going the opposite way. They start going lower again. And what do we associate falling interest rates with? Stimulus? No, we associate falling interest rates with a Federal Reserve panicking because of weakness in deflationary conditions. So inversion in the market is where we don't have the upward slope. We have a little bit of a downward slope that might grow over time, which tells us the market is saying something isn't right. Something serious, there's a serious risk in these marketplaces that's being perceived in these marketplaces, and that they're not just being perceived, they're being actively traded in such a way that it completely upends what's supposed to be a natural, beautiful curve and actually distorts it to the point where it's grotesquely inverted. And that's why we look at inverted curves and say, okay, something's happening here because first of all, it's not upward sloping. And second of all, it must be serious enough that traders are overcoming their natural instinct, they're overcoming all of their institutional biases and are actually distorting the curve in a way that it should not be distorted.
Let's take a look at an example. 2018 through 2022 is our x-axis. And on there, we've got 4 lines that show what the Eurodollar futures curve was on that particular date. And we start out with September 5th, 2017. And then we work our way up to May 17th, 2018. We've got a couple of lines in between there. And Jeff, it seems like what we're observing here is that it started out low, but was upward sloping. Great. And it moved up, the whole curve raised on the back of the globally synchronized growth. And maybe there's going to be inflation, maybe there's going to be recovery. But by the time we get to May 2018, we notice that the front part is moving up somewhat, reasonably enough, I suppose. But relative to the back end is not as enthusiastic anymore. And it is starting to flatten out. Did I capture that correctly? And if I did, tell us what happened then, coming very shortly thereafter, May 29th.
No, I think that's exactly right. You have the two parts of the curve. You have the reds and whites, which were reflecting the hawkish Janet Yellen initial Jay Powell period, where he said, inflation is going to be a problem. We need to accelerate our rate hike schedule. And so you see that reflected in the front part of the Eurodollar futures curve as it evolves in the first half of 2018, which was consistent with globally synchronized growth, the inflation expectations that certainly in the financial media we're talking about as if it was a guaranteed surefire thing to happen. But as you noted, that was just the reds and the whites. When you get to the greens and further down the curve, as 2018 started and then wore on, it seemed like there was almost like two different curves, right? Like the yield curve is sometimes two curves set together. We have the Eurodollar futures curve, again, the reds and the whites, that by necessity, they're reflecting what monetary policy seems, what monetary policy is set today. But then you get to the further out, down the middle of the curve and beyond, and it was, okay, we're seeing warning signs. We're seeing things that are contradicting the inflation growth narrative. During the first half of 2018, we've got the rising dollar, we've got emerging market currencies, we've got a flattening yield curve, any number of other financial and economic data warning signs that are saying this inflation stuff, this growth stuff that's reflected in the reds and whites and Eurodollar futures, yeah, okay, maybe, but we don't think it's going to be able to last very long. And so traders were starting to price, especially in the greens into the early blues, their skepticism, the idea that interest rates are not going to go as high as Jay Powell thought they might. And in fact, when we get to the middle, by May 2018, the curve had really flattened out, which was by itself an unusual distortion, which said the market was becoming very skeptical about the inflation growth story. Because, again, as we said, there's any number of other indications which said that certainly in terms of money and risk, there were less money, rising risks, and therefore we'd expect the Eurodollar futures curve, where it can, to flatten out as it had. So the first half of 2018, yeah, you've got the reds and whites saying we think Jay Powell is going to be hawkish, but then the greens and blues, which were something's not right here, something's wrong.
All right, new graph now. We're starting out with the last date of the previous graph, May 17th. And then what we see is another 3 lines. And the lowest line is the one that represents collateral day, which for those of you who haven't joined us previously, I would describe as a game of musical chairs. And instead of pulling out one chair, you pull out 3 or 4, and the music stops on that particular day. And there's a scramble for the best quality collateral. So there's a panic, and you can see what a retreat. I haven't seen a retreat like this since Napoleon left Moscow. Holy cow, it pulled down violently. And then over the subsequent days, couple of weeks, we see breath returned into that Eurodollar futures curve. It sort of tries to go back towards normal. Tell us, Jeff, what we should take away from this chart.
Well, in the first half, as we said, of 2018, we had these warning signs. The dollar was going up. There was noises in the emerging market currencies in particular. We talked about Urjit Patel, the head of the Reserve Bank of India, talking about dollar funding evaporated, all those things that happened. And then May 29th, as you pointed out, collateral day, that was the serious break where the markets all together said, yeah, this really is a serious problem, and it's probably only going to get worse, which is why May 29th, 2018 shows up on any number of charts. And to this day, you can still see it on any number of charts, which because it was that important to the monetary system as recognizing how what were before collateral risk and general deflationary risk had become very real risk. In fact, not just risk, this is actually happening. As you said, musical chairs where they're yanking chairs out from under people all at once. And leading to this vast scramble for the few remaining pieces or few remaining seats available. And that's an eye-opening experience if you're in these markets. If you have leveraged balance sheets and you're running out in repo, and all of a sudden the collateral availability just disappears, that's going to affect your mindset, not just tomorrow, but going forward. And everybody else can see this inside the marketplace. And so what Eurodollar futures were pricing is this big deflationary negative money problem that was becoming a huge problem more than it had been before, such that it was no longer something that we could just say, this is a could be, maybe it will happen, because it did happen. And so going forward, the Eurodollar futures, going forward from May 29, 2018, the Eurodollar futures curve first, more than anywhere else, started to price out that this collateral problem is going to stick around and probably only get worse. And what that meant was in the greens and the blues, not the whites and the reds, so the Eurodollar futures curve down from the middle on out, we started to see on June 13th, 2018, we did see a tiny little speck of inversion. So the curve had flattened out before then. Then June 13th, we get this little bit of inversion especially in the green contracts, which said, okay, this is post May 29. We know things went wrong. We don't see anything getting better. And it's not really a random coincidence that the inversion happened on June 13th either. So the market is saying things are getting worse.
Exactly. So we were describing up to this point the rise and fall and then the flattening of the Eurodollar futures curve. And now, June 13th and June 14th, we observe our first inversion. And as you just mentioned, Jeff, the last thing we're going to talk about in this part of the episode, it wasn't a coincidence. The Federal Reserve came out and they made an incantation. It was really incantation. It was chanting, and they included a new magic word that was supposed to signal reflationary fire, rocket fuel. Wow. They were really going to burn the house down the day after. What a stain on their professional reputation that this market the day after said it. Just what a rejection. Maybe it was a coincidence, Jeff.
Yeah,
was it a coincidence?
No, what are you guys talking, right? I mean, the market, we had just gone through May 29th. We got the dollar going. We got all of these negative deflationary indications, and these people are off talking about they're going to introduce this symmetrical inflation target, which is supposed to be reflecting this positive, optimistic outcome, this hawkish policy. And everybody in the marketplace is just shaking their heads like, what are you guys talking about? We have very real monetary problems here. You don't even know what the hell they are. You're going off into the symmetrical inflation target when we're talking about collateral. So I don't think it was random coincidence that the Eurodollar futures curve first inverted the day of the second day, the wrap up of that Federal Reserve meeting, which that announcement was made, because the market said, we don't really have a very good opinion of these people anyway. And it's obvious they're not going to help. It's obvious they're going to make the situation worse because they don't know what they're talking about. And they distract the public by all of these shiny objects that have no bearing on how the market or the economy actually works. So this was like sort of, hey, May 29th, this is our last chance to get things right before things really go wrong. And the Fed comes out with its garbage. And so the Eurodollar futures curve inverts and throws in the towel on the whole thing and says, we're going into a downturn. There's really probably no way to escape it at this point. The Fed was, an infinitesimally small chance the Fed could have helped. And now that's gone because these people are just off in their own little world. So that's where we get the inversion. And rest of the story, as we know, the inversion proved to be completely, utterly, fantastically accurate and predictive.
In part 2 of this episode, we're going to talk about what happened in December 2006. We're going to talk very quickly what happened in July 2020, and then focus the rest of the part on December 1st, 2021 right now. So don't go anywhere.